Welcome to Markets Radar with Jeremy Quintanilla. This is your home for markets, stocks, bonds, crypto, foreign, and everything in between. And I give you my take on what it all means. I'm recording this on July 21st, so the news may have changed by the time that you hear this podcast. If you are new to Jeremy, which is myself, you can follow me everywhere on social media at Age of Jeremy. I own multiple businesses such as 3T Warrior Academy, Freedom Insurance, Blockheads, the creator of Merlin, the smartest way to track your crypto. And I also own Q Financial and Age of Radio. One of my favorites, obviously, is Age of Radio because I love making podcasts, making media, making content. And if you want the inside on everything that I'm doing, go to my Instagram channel, subscribe to my dope insights and updates. I give extra info there, working on some extra shows for those people. I don't know. We're working on a lot of stuff. We have a lot of stuff going on, but right now the focus is on growing Markets Radar. So if you could, I'd love it if you could share this with 2 people or 1 person, or comment on it or review it. Something to that nature would be very beneficial to get this in front of more people. My mission is to give people the tools and the insight on to understand what's happening in markets so that they can learn to do the research on their own so that they can create sovereignty over their own wealth and over themselves. Now, if we look at Wall Street, as dip buyers emerge from the shadows, the spotlight is squarely back on technology, lifting stocks on bets that the artificial intelligence trade, the very engine of this recent bull market, still has plenty of room to run. Leading the charge are the beaten down semiconductor shares, with the key industry gauge recently surging 5%. Now we're seeing NVIDIA successfully push its latest chip designs to customers, and Intel is starting to climb higher following plans to cut more jobs. This semiconductor rally helped the NASDAQ 100 add an impressive 1.9%, completely overshadowing geopolitical risks that are currently boosting oil prices and stoking inflation fears. If you're wondering whether this is just a fleeting bounce, the trading desk at UBS suggests otherwise. They note that much of the speculative positioning in these momentum stocks has already been unwound. In fact, hedge funds recently slashed their long positions in semiconductor shares by about 5% of their gross market value, marking one of the largest reductions on record. Adam Turnquist over at LPL Financial summed it up perfectly, calling this recent correction a healthy reset following a parabolic advance rather than a fundamental breakdown of the AI theme. So when we think about what's going on with AI, we can know, or we have felt that we've known there's going to be a pullback. I don't think that we're in the stages of this collapsing. We're getting towards the late stage, what we would call the dot-com burst. We're going to start seeing more and more things consolidate. Hopefully we don't have like record crashes in these areas. We just have continuous pullbacks over time, but this could be the beginning of the AI bubble starting to pull back, stabilize, and then starting to pull back more. And then eventually you have the bubble kind of burst, which I think is going to happen probably as we go past the midterm elections into 2027, maybe into the middle of 2027 to the end of 2027. I think that we're going to see a really big pull back on a lot of these companies. We'll start to see that a little bit as we see, like I said, more of the companies consolidate, but more importantly, with Anthropic situation about trying to do their IPO, and with OpenAI doing their IPO as well, we will see a lot more of what's to come once those things start to happen. But a lot of the skepticism is mounting regarding the vast sums being poured into data center development, right? So when you have a bunch of money going after something, that's one of the key things that we say, okay, well, how big is this going to go, and is it building too fast? Because essentially, if a bunch of money pours into something and it's moving too fast, that's when you're going to see the remnants of, say, a recession type of pullback or dot-com bust. Investors are scouring upcoming tech results for hard evidence that these massive AI investments are actually generating returns, which has been one of the key concerns that I have had. Now, again, there has been some mega cap reporting season that's kicking off with Tesla and Alphabet on Wednesday, followed by a heavy hitter lineup of Microsoft, Meta, Apple, and Amazon the following week. If we look at Brett Kinwall at eToro, he notes that investors are no longer just asking if companies can withstand uncertainty. They want growth and guidance strong enough to justify today's elevated valuations. Because what's happened is in a lot of these spaces, companies are being essentially overvalued because there's not a way to gauge whether or not the income coming from the AI play is paying off. We're starting to, a lot of the thought was that AI is going to replace jobs, which is going to lower expenses, but the cost to continuously run AI to manage the data centers may have not been the correct trade-off for getting rid of the employees, where it could have been less expensive to have employees do stuff rather than putting everything into artificial intelligence. Now, I don't think artificial intelligence is going to go away. I'm a big believer that it's going to consolidate into a big few techocracy stocks, and then they're the ones that are going to control all of it, which is why I've been adamant that we need to have more companies look into small language models, other large language models, how AI can be created for niche specific services. One of the companies that I like now, again, these come from large language models, but this is a company that's using a large language model and then they are creating revenue from it, which is Tax GPT. I have that to help answer any tax questions that I have or to do research for me for customer specific situations. And so what I would like to see, or what I think is where we're going to see a lot of AI really helpful, is when we see AI being geared towards these niche services that I think can create these new types of revenues, which means that the companies that are giving up the large language models for these things to be created, they need to come up with a strong revenue model for that. And then we need to see prices come down inside of the infrastructure building. If those things don't happen, then we can definitely see something like a crash in the AI or the AI bubble specifically burst. Now, overall, the nascent Q2 earnings season has been solid. Over 90% of S&P 500 companies reporting so far have beaten profit estimates. Mark Heathfilet at UBS Global Wealth Management, who sees room for global stocks to move higher amid this strong profit growth, though he advises keeping a diversified portfolio to hedge against ongoing inflation and geopolitical risks. Again, you should always keep a diversified portfolio, but don't over diversify. Come up with a diversification plan, stick to it, and continuously invest that way into it as well. One of the other reasons why I mentioned so many companies and try to quote so many people is the way in which I've been able to build knowledge all these years is when I hear about a company that I don't understand, or I find something that I don't know or have never heard of before, I like to go and research that. That's one of the reasons why I like using Claude or ChatGPT or Gemini Notebook, is that when I learn about these things, I can go and ask questions to these models and get answers on what these businesses are, learn about them, educate myself on them. And that's what's opened up my, I guess, wealth of knowledge in this space of what's going on, because of listening to podcasts like mine and because of quoting people, and I can go and research them. And I encourage you to do that as well. One of the things that I'm really excited for as we go into continued earnings weeks, Alphabet is going to kick off some of the mega cap reporting season alongside with Tesla. And that's where I'm more interested in seeing where their revenue has come from. I think that one of the best companies that is still underperforming in my perspective is Alphabet. I think that Sundar is one of the best CEOs of all time. I think that they are making much stronger plays at Google. And I think the technology that they're building, like Google Anti-Gravity, which is their coding, their AI coding IDE or integrated development environment, is fantastic. The Change Gemini notebook, really focusing on the Gemini brand. There's a brand new home speaker that I ordered that has Gemini built into it. And I think Google's poised to be the first company to successfully bring AI into the home. And I think that as far as like home goods go, and I think that positions them in a really good spot, especially if you think about how OpenAI was trying to work with John Ivey, the designer of the iPhone, to come up with a speaker type AI system. And so I feel that Google is in a much better place because Google is probably already in our homes in the form of Nest products. And with that AI capability, those products will be able to work together a lot better than introducing a new type of speaker into the home. So I'm really excited to see what happens with that. Google also is getting into the more into the health space as it relates to their Fitbit. Not Fitbit, their Fitbit line. They changed the Fitbit line to streamline with Google, and then they started to competing with Whoop. Now I think that the Whoop band is still better. I'm wearing it right now. I was looking at it while I was saying this. But if you look at where Google is at a tech company, this would be one of the strongest times, in my opinion, to buy Google because I still personally believe that it's highly undervalued in the long run. We'll be right back. Moving from one tech giant to the next, I do want to bring this up because I think this is interesting. This could be a good sign. Could be a good sign, could be a bad sign for Apple. I'm not really sure. But Apple is launching the Apple Upgrade Leasing Program. So if you're in that mindset that you are going to own nothing and loving it, this is an extension of that thought process, I imagine. The leasing program goes live on July 28th in the US. They're partnering with Klarna Group as the program's financial backer. The program is designed to boost sales as Apple raises prices on devices like iPads and MacBooks due to surging chip costs driven by the AI industry. And again, Apple does not have a really good AI play, but I will be honest, if there is any wearable that I'm excited about, I might be the only person that is excited about this. I am excited for an Apple AI pendant. I am looking so forward to that. I want it so bad. So I think this is a good move for Apple, but this is also a subscription model, which also frustrates me. The program will function as a subscription model, allowing users to switch to a new device before their term ends. So you will literally be paying for an iPad for freaking eternity, or you can simply keep it once the lease concludes. Apple intends to market Apple Upgrade as offering lower payments than its current financing options to clear the way for this new initiative. Apple will stop accepting newer enrollments for its standard financing and the existing iPhone's upgrade program. It will support most Mac, iPad, Apple Watch, and iPhone models. However, unlike the current iPhone program, Apple Upgrade will not include Apple Care. Business and education purchases are excluded, as well as specific devices, including the iPhone 16, MacBook Neo, Apple Watch SE, and the entry-level iPad. The service will be available to consumers both online and in Apple's physical retail stores, which they have beautiful stores. I'm not going to lie. They make beautiful products, and hopefully they will get their head around what they're going to do with AI, and I hope that you enjoy paying for your iPad for freaking ever, because who wants the old technology when you can have the new technology? And one of the greatest new technologies that is out is cryptocurrency. The Clarity Act, is it going to pass? Who knows? If you don't follow Merlin, head on over to Merlin Crypto on Instagram. We have some cute little memes that we're going to be posting here hopefully this week about the Clarity Act. And I think that Washington is looking to get the Clarity Act up and running, maybe signed. I don't know. I feel that in this administration, everything is just talk. Washington is finally moving toward a much clearer rule book for digital assets. Bitcoin just pushed more than 2% higher, zeroing in on the $67,000 mark, while shares of crypto exchange Coinbase skyrocketed as much as 12.6%. This sudden surge came directly on the heels of major comments from Treasury Secretary Scott Bessent, who declared that lawmakers are currently at the 1 yard line with the long-awaited Clarity Act. But sometimes when you are at the 1 yard line, I probably shouldn't be using this analogy because I don't know enough about American football, but if you're at the 1 yard line, sometimes you never get it over the goalpost into the end zone. One of those things, or it could be intercepted and run the other way. You never know. But supposedly they're at the 1 yard line. Bessent didn't mince words, actively urging Congress to get this bill across the finish line before they leave for recess. whenever they say recess, I picture all of them going out and like swinging and pushing each other on swings. Like I feel that recess is a time when you could be on the right or the left and you could all gather around one fundamental goal of playing on a swing set. And I think that they should do that. This news didn't just lift Bitcoin, it sparked a broad rally across smaller tokens as well. But is this just a headline driven pop or the start of a sustained run? Analysts are suggesting that the sector's recent downturn may have officially run its course, but who knows? I have a lower buy target in for Bitcoin, so I'm hoping that it falls. I'm always hoping cryptocurrency falls because I know in the long run it'll go back up and I can make money as long as I have an exit plan, which is why we have Merlin, the smartest way to track your crypto. And there's a link to get 30 days for free in the episode description as well for Merlin. Bitcoin has climbed about 14% this month, breaking a streak of 2 consecutive monthly declines. There are technical and institutional backdrops that have quietly improved while retail investors weren't looking. Specifically, there is a spot ETF inflow that have turned positive again. Trading volumes are actively recovering, and derivatives data show that selling pressure is finally fading. Now, we could also look to the previous crypto bear markets. They tend to bottom out through prolonged, boring periods of stabilization rather than one massive, dramatic capitulation event. Using this, you could argue that the recent correction has lightly exhausted itself, because what ends up happening is when money flows away from it, you see a really big pullback in cryptocurrencies. They slowly stable, they dribble down a little bit, and then you can start seeing them come back as other money flows back into it. Because again, some of this money went to the AI distraction. And since the beginning of June, the original cryptocurrencies has been stubbornly range bound between roughly 60,000 and 67,000. And Stéphane Quillette over at Front Financial, the reason was simple: distraction. Investors completely shifted their focus toward massive AI trades and high profile equity offerings such as SpaceX. So again, when you take that into comparison, the thing about cryptocurrencies is really volatile market. Money comes in fast, it goes out fast. That's why having an exit strategy, not to continuously push Merlin on you, but that's why having an exit strategy is important, because these aren't traditionally right now, because there isn't a Clarity Act passed. There isn't policy around this in the United States. So there's not a really mature market. So when something shiny looks shiny over to the right, the people that are in crypto go over to the shiny thing. And then as that kind of stabilizes, it comes back into cryptocurrency, and then you see it kind of grow. So again, markets are very cyclical, and the AI frenzy, or as the AI frenzy begins to calm down, it is setting Bitcoin up for a major bounce, in my opinion, as well as Stéphane Ouellet. Bitcoin's hovering at the top end of its recent range. The path of least resistance is higher, and he sees an elevated likelihood of a breakout as the market gets more comfortable with future path of interest rates and as the AI trade slows. A big catalyst for some of this maturity is going to be the Clarity Act, as I previously mentioned. This is a massive relief for a market that has been absolutely battered since a surprise crash last October, liquidated swaths of positions, and destroyed investor sentiment. For months, investors were panic selling every minor rally, preventing any meaningful recovery. But now analysts at the crypto firm Tagus are officially calling a shift, noting that this renewed institutional interest stands in sharp contrast to the severe selling pressure and record redemptions that we saw earlier this summer. The bottom, it seems, may finally be in, but only time will tell, because again, we're 1 yard line to the fading AI distraction. The stage is set for a fascinating quarter in crypto, but we'll have to keep an eye on what Congress does with the Clarity Act. We'll be right back. We're closing out the show by heading across the pond to a massive structural shift happening in European trading. For decades, the opening and closing bells have defined the rhythm of Wall Street and the City of London, but that era is rapidly coming to an end. The London Stock Exchange has just announced it will open a broad new venue called LSE 24, designed to offer, are you ready? Near continuous trading entirely outside of its regular market hours. Operating as a separate platform from the main From the main platform, the LSE 24 will keep the lights on from 5 p.m. all the way to 7:50 a.m. in London. This is part of a massive global arms race among exchanges to attract international capital with round-the-clock trading. The LSE is playing catch-up here. The New York Stock Exchange, NASDAQ, and CBO have already unveiled proposals to extend their trading to 23 hours a day, 5 days a week, and the CME, the Chicago Mercantile Exchange, is planning 24/7 trading for crude oil and gold futures. But for the 300-year-old London Stock Exchange, this move isn't just about modernizing. It's a critical defensive play to stop a worrying bleed of relevance. Because in today's world, we're so fast, we have to move all the time, apparently. Speed, 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 and never slow down. The London Stock Exchange is navigating a very tricky period, struggling to attract new listings, while a spree of takeovers shrinks the number of companies actively listed on the market. Again, if you think about capitalism and how it consolidates over time, you would know that this would, given a long enough period of time, happen. And that's why we have to think past capitalism at some point to maybe even a better economic system that can work for every person. UK's position in global market capitalization has actively slid in recent years, recently being overtaken by markets in Taiwan, India, and Canada. Again, Taiwan, India, and Canada, when I mention things like that and you hear that in the news, go and research what's happening there, because those might be places where you want to stick some of your international money. Now, there has been a collapse of the London's initial public offerings market. The venue fell out of the top 20 globally for IPOs in the first 9 months of 2025. Yes, there is an IPO market. Highlight that the highlight here is the optimism for a 2026 revival, but it's fading rapidly. Closely watching the IPO candidates like Waterstone's booksellers are considering delaying their listings until 2027. I wish Waterstone Booksellers was here, but they're looking at delaying their listings until 2027, leaving London with only one sizable IPO so far this year. But again, there are probably some really smaller ones that are going on the marketplace because, again, the purpose of an IPO is to create liquidity to either pay off initial investors, to get capital, to grow the company, kind of like in the SpaceX situation, in my opinion. But again, for big IPOs, they've only had one sizable one for 2026. The LSE must do something drastic to draw back global asset managers and retail investors, especially since major UK institutions like pension funds have pulled back their domestic investments and they're doing international investments, which would be over here in the great United States. The exchange says that the platform will be ready for client testing by the end of 2026. But they aren't diving straight into regular stocks. The first tradable assets expected in the first half of 2027 will be exchange-traded products, or ETPs. LSE's, or London Stock Exchange's, Chief Executive Officer Julia Hoggett explained this strategy perfectly, noting that ETPs are instruments where globalization is very evident in the demand. By starting with ETPs, the LSE can lean into the international crowd immediately. Equities might be the next step, but that requires navigating some red tape, including approval from the Financial Conduct Authority and buy-in from market participants. Hoggett noted that expanding into continuous equity trading could actually create a divide between investors who want a condensed trading period and those demanding 24/7 flexibility, ultimately concluding this is about having the right form of liquidity for the right form of market at the right time. For everyday retail investors, this is broadly a win. Hector McNeil, co-CEO of Han ETF, pointed out that this gives retail traders the flexibility to react instantly to market-moving news that happens while traditional markets are shut, which is the reason why I like these. But McNeil also raised the million-dollar question: will markets actually show up to provide consistent pricing during the overnight sessions? If no one participates, the London Stock Exchange 24, also known as the LSE 24, could face severely limited liquidity right out the gate because, again, you need people to buy and sell in these marketplaces. From the massive AI bets in Silicon Valley to the dawn of the 24-hour stock market in London and also in the United States, we're going to be keeping an eye on these because we cover all things markets. And that's all that we have for today. Is I always say, be thankful, grateful, and kind. Make sure that you check out the regular Age of Jeremy episode dropping on Wednesdays and another episode of Markets Raider dropping on Saturday. We'll talk with you soon. Bye.